Hi, welcome back. You're watching Trading Hour. Here's some market opinion. Earlier today, we caught up with Nilesh Shah, MD and CEO at Envision Capital, who says that it's a good time to start accumulating IT stocks and has also spoken about his market outlook. Hear him out.
The valuations, the P multiples have become a lot more reasonable. And our view is essentially that don't expect the margins to further deteriorate from the current levels. The demand environment still is pretty much intact. We've not heard of any IT companies talking of any slowdown in terms of demand. Even if we reflect back to the past crises which markets like the United States or Europe faced, even in that kind of an environment, the demand for Indian IT services companies was pretty much non-discretionary. So to that extent, we now see an environment where the demand is intact. The margins perhaps have moderated or have bottomed out, I'd say, and valuations have become a lot more reasonable. So from here onwards, we don't expect the IT sector to be an underperformer. I think it's a good time to start accumulating a lot of high quality, growth-oriented IT stocks. I still expect India to be an outperformer in context of what's happening globally. Just look at some of the growth estimates. The fact that GDP growth is still expected to be 6 to 7%. Inflation is going to be still subpar what we are seeing in developed markets, and at about 6 to 7%. We're still talking of nominal GDP growth of about 12 to 13%. And with margins now expected to improve because of the way commodity prices have fallen or the raw material and input prices have fallen, expect margins to probably hold up or even get better over the next 2 to 3 quarters. So overall, the way we look at India is that we see a nominal GDP growth of about 12 to 13% and maybe an earnings growth which is in probably the high teens. Autos continues to be one of those opportunities of growth from an India context. I think combined basis autos and auto components is a space we've been pretty optimistic about. We've been owning it in our portfolios and continue to like this space. Of course, some of them have run up quite a bit, especially in the auto hang space. So of course, you could probably take some profits off the table, but otherwise, it looks that for the next 2 to 3 years, Indian autos and auto components put together are going to be on a comeback trail. Some of it is priced in. We're getting into an environment where we could probably see a double-digit growth in demand backed by margin expansion, which I think is pretty good in terms of earnings growth from a 2 to 3 year perspective.
Okay, that's the view coming in from Nilesh Shah. He's saying that IT perhaps may not fall so much from here. By the way, the markets have recovered. So from the day's low, we've managed to climb back above that 17,050 mark. It's a gain of close to about 0.25% on the benchmark indices and individual names. Keep an eye on HCC. It's a small company in terms of price. Now the stock price is just 14 rupees, but it's rallied about 18%. This is after their debt resolution plan was approved. Now the debt on the company's books will come down to 3,575 crore, which will help the company save 400 crores in annual interest payments. Big mover there. Wrap up on Trading Hour from the entire team. Thank you for watching. Stay tuned. Halftime report is up next.